Nate Krampe here for Lions Wealth Management. Over the last couple of weeks, there's been a lot of action with the markets and a lot of action with the government and all the things they're doing to try to help out small businesses, to try to help out corporate America, and really trying to make sure that we can get past the virus and this recession. Well, three things we're going to be talking about today. First of all, we're going to discuss the fourth branch of the government, as I call it. Then we're going to dive into patience. In the last aspect, we're going to dive into the planning aspect of this, and that's going to be charitable gifting. Okay, let's start with the fourth branch of the government. Now, this is not necessarily something that is true, and I'm calling it the fourth branch of the government because they're really involved in the government, but it's Blackrock, the publicly traded company. Now, Blackrock in itself is run by a gentleman named Larry Fink. And he is the co-founder of Blackrock, and he's been very instrumental in a lot of things that have been happening with everything in the bond market as well as possibly the stock market as well. You see, there's a couple of things that we look at here. We look at who controls kind of all of the Wall Street, and a lot of it runs through Blackrock, especially the exchange-traded funds, the ETFs. Now, that's a big deal because a couple months ago when the Federal Reserve was having a lot of issues with bond market, they came to Larry and said, you know what, we need help. Larry said he would be glad to help. He did a lot of things possible, and the Federal Reserve said we need to implement kind of a stimulus package for bonds, and we need to be looking at junk bonds. We need to be looking at bonds of companies that are in really bad shape. So one of the things that happened was BlackRock took over about almost $1 trillion, about just a little over $750 billion, and they pumped it into a couple of their ETFs, a couple of their investments. That helped the bond market and kind of stabilized everything. Well, that's just kind of a precursor to what may be to come if we continue to have a bad time in the stock market, which we really haven't as of the last couple of weeks, but if we continue to keep having, I would expect that there may be some more now precedents for the Federal Reserve to step in and say, all right, we're going to help out the stock market by purchasing shares. And what company do you think they may go with? BlackRock. So that's just something to be aware of, is that there's a lot of things happening behind the scenes to help out the markets, and it's just interesting to know who's in place to help that. Now, why do I say that? Because there's a lot of things that are happening right now. And what you can see by this chart is that there's a lot of communication happening by the Fed, and that's a big deal because of the fact that the more times they have communications historically has been some very poor times in the economy. So we're seeing a lot of action, we're seeing a lot of communication, and just know that that is still signaling and showing, just historically, that we are in bad times with the economy, and we're just having to muddle through this. So that leads me to our next point, which is patience. Now, patience is something that is, why I'm saying this is really because of the fact that we have been in a great kind of roaring, what you call bear market bounce. And this means the stock prices are going up, but the trend is still a bear market. The trend is still downward in the stocks. And why that's important is because of the fact that when we're taking a look at long-term perspective, yes, we can get kind of the short-term moves wrong in 1 week, 1 day, couple weeks, but over the course of the long term, things are still signaling that we're a long ways away from corrected and fixed in our economy. Now, also what we're starting to see is that a lot of people started to use their stimulus check to open up trading accounts. And we're at some of the highest volumes of trading accounts right now that have ever been seen. And we're starting to see the highest volume of what you call options. Small accounts that are leveraged 100 to 1 of saying the markets are going to continue to go up. And usually when that happens historically, and I know this data set's not very old, but historically, going back, that signifies that there may be some more hard times to come. So that's one word of caution. Then we have this chart as well that shows that there's still some hardships with valuations of companies. And what that means is what we're willing to pay versus what the earnings of the company actually are. Now, we are at some of the highest points in history, and that's never a good reason to say let's continue to keep buying stocks, but it's also never a good reason to say let's sell stocks. But here's the other chart that is very interesting, at least to look at. This one shows, if you look at the top part of it here, that historically, over the last 20 years is what this one's showing, and this is what I've talked to most of you about in the last couple of years. Whatever the economy does, over time the stock market follows suit. And it's almost a one-to-one correlation, meaning it's almost it's literally just slightly less than 100% true that whatever time the economy goes up, the stock market follows suit. Whatever time the economy goes down, the stock market follows suit. Well, what has happened since March 23rd, since our lows? Well, the stock market has gone up, and the economy has still continued to go down. So there's something interesting in the works here. Either one of two things are going to happen. Either the stock market is correct, which actually very well could be, and the economy is getting significantly better just than what it was, and it's going to start rebounding and pick this up, or the exact opposite is true, and that we're not getting much better in our economy, and the stock market is over time going to start going back down. So the answer is we don't know, but that's where it comes to the math and what the math says. And right now, the math of the economy, the math of the stock market shows that we're not in a new bull market yet. We're still in a bad place with the stock market, and that alone is just cause for just at least a little bit more patience. Alright, let's figure out the last point here with charitable gifting. Now, there's a lot of things that we can do with charitable gifting, and when you take a look at all of the things that are going on, this year actually may be a great time to give cash. You see, the government has come out and said under the CARES Act that you can give cash. You can also give stocks, but you can give cash, and that alone may be a great place to be invested solely on the fact that when we give cash under the CARES Act, now you can deduct 100% of that against your income. So that's never been that way in the last number of years. We've usually only been able to deduct up to 60%. Now you can deduct 100%. So that is also a reason why we may want to accelerate some of the gifts for this year as well, because of the fact that we are able to do this under the CARES Act and also some of the tax provisions. And don't forget the fact that we don't have to have a required minimum distribution either. So all this is saying that this is a great year to be gifting as you are able and want to. Now, you may not have the charity to gift to. You may not have a specific place you want to gift. That's where foundations and what I want to talk about, the donor advised funds, come into play. You see, donor advised funds are a great place to be invested, and what they do is act like a charity, and it's a holding tank. Now, if we give cash, we can put it in there, and here's the thing, we can invest it. We can hold the cash there as well, but we can invest it if you want to, and start growing it with the markets for a rainy day in the future. But that's a great way to take care of the deductions. It's a great way to have a place to give in the short term, so you can find the best charities that you want to give to in the long run. Okay, so we've gone through those three things. That there's a lot of things happening with the bond market and the stock market under the surface. A lot of it's being perpetuated by Blackrock in tandem with the Federal Reserve. The second thing is we still need to have patience. We're not out of the woods yet with the bear market. And the third thing that we talked about was charitable gifting. Giving cash. Obviously, with the CARES Act, this may be a great year to accelerate some of the donations. And if you have questions, I'd like to talk to you about that and see if that's going to work part of your wealth plan. With that, take care. Have a great rest of the day.